Morning, everyone. Welcome to the SAFRI webinar about the Autumn Statement. My name is Adam Kay. I'm a partner in our London office. So this is what we're going to be covering today. Jeremy Hunt is the 7th Chancellor in 7 years since Brexit, and it came up in a quiz. I don't go to very interesting quizzes. It came up in a quiz I sat recently, and I had to name them all. And it was, so for your information, it was Osborne, Hammond, who did three of the 7 years. So he's pretty good by those lights. Javid, Sunak, Zahawi, who I forgot, Kwasi Kwarteng, and Jeremy Hunt. So there's quite a lot going on in the sort of Chancellor role, and there was quite a lot more tax yesterday than we expected. Part of that was political. So the Chancellor found himself with a sort of Christmas present under the tree of £27 billion of fiscal headroom, which he wanted to spend quite reasonably so as not to leave it for Labour if and when they get in. He wants to make sure that that's all spent so that Rachel Reeves, if she becomes Chancellor, can't cut taxes on day one. The reason there was headroom was because there are spending cuts penciled into the Conservative spending plans of up to 3% of GDP, which is enormous. No one thinks that that will actually happen, but nevertheless, they're there. So that creates the headroom. And also we had inflation means that fiscal drag happens, which means that tax rates are higher, which means that there was a bit more cash. So that was one reason. We had stuff yesterday. The other was that there was a raft of consultations. It's quite a bit frustrating to do these sometimes because you have to say, well, okay, there are loads of consultations announced, but nothing concrete. And then the pleasure is deferred, and we've had some of these consultations come to fruition, if that's what consultations do, and so there were some of those announcements yesterday too. On the personal tax side, the big thing, which the Chancellor announced yesterday, was 3 changes to national insurance. The first of those was a reduction in the basic rate of Class 1 employee contributions from 12% to 10% from 6th of January 2024. If you listen very, very carefully, you can hear a sort of sighing, moaning sound, and that's the sound of payroll software developers realizing that they're not going to be spending Christmas with their families this year as they race to update their software so that it can cope with this in-year change. There has been some speculation that this might mean a May election when you'll have the voters will have had a few months of this in their back pocket, which seems quite sensible to me. The second change was the basic rate for Class 4 self-employed contributions from 9 to 8. And in each case, the higher rate, so the rate above the upper threshold, remains at 2. Very, very broadly, you've got about 37.5 grand of income, which is taxed in that sort of basic rate band. So someone earning more than 50,000-ish will receive 2% times that 37.5 grand, and it's 754 quid a year is the maximum that an employee will get, and it's half that for an employee because it's a 1% cut rather than a 2% cut. So that's the effect of those. The other thing that the Chancellor did yesterday on NIC, and if we had slightly more budget in our marketing team, you'd have seen sort of bunting appear and some sort of happy GIF behind me, was that we actually had a tax simplification yesterday. We've had, I think it's 1 new tax every year for the last 15 years, possibly 20 years. And so it's good to sort of very nearly see the back of one yesterday, which is nice. Class 2 NIC is going to be abolished for the vast majority of people from 6th of April 2024. It's not quite dead, so it's sort of merely sort of resting. People earning less than about 6,500 sometimes, and they often should pay Class 2 NIC on a voluntary basis to maintain their access to benefits and pensions and things. And so that is staying on, but there are promises of future changes there too. A few other sort of random points here. There was quite a lot of chat yesterday about, well, yes, the Chancellor is giving with one hand, but he's also taking with the other because of fiscal drag. So the personal allowance is being frozen for the next 4 years. The basic rate band of tax being frozen. The additional rate thresholds being frozen, has been frozen since whenever. And so, yes, that is definitely happening. And if you earn more than about 50 grand, then you're losing out considerably more from the fact that the bands haven't changed than you're getting on the NIC sort of cut. However, the bands being frozen is a stealth tax, and stealth taxes are called that because they're quite hard to notice, and so it's not going to be immediately obvious. You will pay less on the 6th of January than in tax than you would have otherwise, and so it will still feel like a tax cut. And also, a lot of the people who talk about fiscal drag earn more than about 50 grand. So if you are earning less than 50 grand, then I did some very basic maths, and you might say, well, okay, the freezing of the personal allowance will cost someone earning more than about sort of 12 grand. That will cost that person 160 quid, something like that. And so you are actually still better off. If you're in the sort of squeezed middle, you will still be better off here. And the fiscal drag is for higher earners. So that's the first thing I thought I would mention. The second thing is that why NIC? Well, and there was some sort of conservative commentary yesterday bemoaning the lack of salience, was the word they used, which I quite like that word. What of that tax cut? Why not cut income tax? Well, NIC is cheaper. It cost the government about 5 billion quid to do all of that yesterday per year, whereas it's about 6.5 billion to cut income tax by 1%. So it's also focused on workers. So savers don't benefit, pensioners don't benefit, although they had a pretty good day yesterday with the state pension changes. So it's that sort of focus. So that's potentially why the Chancellor did it. A few other things which got sort of slipped in yesterday, which you may or may not have seen. The first on ISAs, limits were frozen again, so they haven't changed for a while now. A couple of new types of assets are going to be permitted in ISAs, long-term asset funds. So those are illiquid funds buying things like infrastructure, stuff like that. And certain kinds of open-ended property funds are going to be allowed as ISA assets, just as big providers stop offering them because they don't offer, because people don't want to buy them. But nevertheless, should you be one of the number of people who still likes those kind of property funds, you'll be able to get them in your ISA. You'll be able to have multiple ISAs of the same type, which is jolly good. So multiple cash ISAs. You will also be able to do partial ISA transfers, not full ISA transfers. And you may have seen the sort of brouhaha about fractional shares. HMRC have said it is not permitted to have a fraction of a share inside an ISA, which I think betrays an understanding of how brokers work. I do not do the investment in my family. My wife, Mrs. K, is on the investment committee. I'm more a sort of roving advisor to that investment committee. But nevertheless, my understanding is that if you go to a broker and buy 100 AstraZeneca shares, they don't go and get you a little pot of AstraZeneca shares and they have your name on the share certificate and they're yours. What actually happens is you have a proportion of their AstraZeneca holding. And so all ISAs actually contain fractional shares. But nevertheless, the HMRC don't like it and they are going to consult on it, but likely to permit it in the future, which is welcome. A few other things that came in yesterday. Currently, if you earn more than £150,000, even if the only thing you have is employment income under PAYE, you have to file a tax return. That is going to be abolished, which is in theory a good simplification. In practice, I cannot think of a client that I act for, who earns more than 150k and has zero investment income, never makes a pension contribution, never makes a gift aid payment. But nevertheless, should such individuals exist, they will no longer have to file returns, which is jolly nice for them. There is a very welcome tax exemption to sub-postmasters who were scandalously wrongly prosecuted under the Horizon software scandal. So currently they are under something called a historic shortfall scheme, or about 2,000 of them are, whereby they get compensation for the loss of earnings for the fact that they were accused of theft. HMRC, applying the law with a hammer as usual, as they are required to do, are saying, well, that's income. And so yes, they might have been basic rate taxpayers for the last 20 years. They've been trying to clear their name, but actually we're going to tax it all in this 1 year. And so that is very welcome, that people under the 2,000 people under the HSS are going to see a tax saving there. One thing which isn't on the slide, because I found it quite late last night, which is it's in the small print of the autumn statement document. the Chancellor has said that the guidance on workplace training is going to be updated by HMRC to make it clear what you can and can't get tax relief for. Slightly odd for the Chancellor to announce HMRC guidance is going to be updated without changing the law. Hopefully the guidance reflects the law, although if you believe that in every case, then I have a bridge to sell you. So we welcome change. Moving on to business tax, and the biggest single number in the budget yesterday was this: the full expensing of qualifying plant and machinery being made permanent. So a bit of a sort of background to this change. When the corporation tax rate in the UK, it was announced it was going to be increased from 19 to 25%. There was a lot of government chaps saying, don't worry about this, guys. Still, we are one of the lowest tax rates of all rich countries. 25% is not high by international standards. So it will be fine. We're still an attractive jurisdiction from a tax perspective, which forgets that there are two things you have to multiply together to get your tax number in a year. One is the rate and the other is your profits. And the UK has very significantly harsher rules on what you can and can't deduct in order to sort of come to your profit figure than other countries do. So even though our rate is still low internationally, the overall sort of tax burden on corporates is very high in the UK by international, or high anyway, by international standards. So one of the sort of proposals, or one of the measures to reduce that burden, was to the super deduction, which was a 130% capital allowance for certain kinds of plant and machinery. That ran for a few years, ended in April 2023, and was replaced by full expensing. That was due to last for 3 years, and the Chancellor has, it seems quite sensibly, announced that that's going to be made permanent. Even though that is a tax cut, it is going to increase tax revenue in the next couple of years, which it looks to me like some companies would have been accelerating capital expenditure in order to get the full expensing, and they're now going to spread that out. But nevertheless, it's going to be a very expensive, I think about 10 billion a year, something it costs to do that. There were some really interesting points in the document, in the autumn statement document, about tax competition. So of course in the US they have Joe Biden's Inflation Reduction Act, which has been sort of doling out huge subsidies to green industries all around the US. And in the EU they have the Net Zero Industry Act, which is the EU's response to that, and again some significant subsidies available there. And there has been some question about whether the UK would adopt something similar. And the budget, the autumn statement document, says, no, this is it. There's a bit of targeted funding for certain industries, but this is the UK government's response to that. And it remains to be seen whether that will be enough, although I note today Donald Trump saying overnight that he was going to gut the IRA. So perhaps businesses will prefer the certainty of the bipartisan support that this enjoys in the UK to what's going on elsewhere. Anyway, just a little bit of a chat about what full expensing actually means. So it means 100% tax relief for qualifying plant and machinery. So if you invest £100 million in plant in the UK, then you get to deduct £100 million from your profits, which hopefully exist, and then you get effectively 25 million of tax relief for that plant and machinery. There is a 50% rate for special rate assets. So there's things like fixtures and fittings and heating and stuff like that. Assets have got to be new, so you can't get full expensing on second-hand assets. You can't get full expensing for a leasing trade. If you sell an asset, you get a clawback, and the rate depends on whether it's plant and machinery or special rate assets. But nevertheless, you've got basically a tax charge when you sell one of these assets that you've claimed full expensing on. We had a case called Gunfleet Sands, which came out a couple of weeks ago, and that's a really good reminder when you're dealing with capital allowances, it's not just about the rates. So Gunfleet Sands is about wind farms, and the question was, do all of the costs that the business has incurred in building and this wind farm qualify for capital allowances? And the answer was no. Some of the viability studies, some of the sort of work that the company did around the project, not only was it capital, so not subject to corporation tax deductions, but also it wasn't plant and machinery, so you couldn't get any tax relief for it at all. So it's really important that when you are thinking about that expenditure, you think very carefully about the scope and what reliefs are going to be available. One of my fellow partners said to me yesterday, so does this mean that capital allowances are gone then? And I sort of said, oh, my sweet summer child. No, that is very much not the case. The full expensing is something that sits on top of the additional of the existing capital allowances legislation. Firstly, it only applies to companies. So unincorporated businesses still have all the old rules. That includes the AIA, the annual investment allowance of $1 million, and then your sort of normal writing down rates, and there are also first year allowances for certain kinds of sort of green investments and stuff like that. Companies have to consider both sets of rules, so the full expensing for their new stuff, their new qualifying stuff, and the old capital allowances rules for their non-qualifying assets. You've also got investment zone capital allowances. So there's quite a lot going on here, and it's not a simplification. It's just more legislation. There is a consultation on simplifying the capital allowances legislation, which we understand is not going to mean new relief, but it's going to hopefully be simplification. See if that happens. And there is a consultation going to be announced or going to be released on extending full expensing to assets intended for leasing. So again, watch this space. On other business tax stuff, the spring budget had a consultation on expanding the cash basis, i.e. currently this is something you opt into rather than happens by default, and they're going to swap that round so that most small businesses will use the cash basis, and they are improving it. You can opt out if you want to use accruals, but they are improving it by removing a couple of restrictions. One, that you are allowed to sideways loss relief, which you're not currently allowed to do under the cash basis. Secondly, that you can get more relief for interest, which is currently 500 quid or something ridiculous. You'll be able to get full relief, and you won't be kicked out of the scheme as you get bigger. So most small businesses will now be using the cash basis going forward. So that's just something to bear in mind. Think about things like if you're making provisions against future expenditure, it may be that this is worse for you because it will reduce it'll defer your costs. A couple of points on CIS and IR35. The government are adding VAT to. So the thing about construction industry scheme is if you're a subcontractor, you want to get gross payment status. So you don't want the government or the payer deducting income tax from the payments they make to you. Gross payment status is really important for a lot of subcontractors, and you have to be a good boy or girl on your tax in order to get that. And not only do you have to now be a good boy or girl on direct tax, but also VAT. So again, it makes it harder for a subcontractor to keep GPS. And the other thing which is happening is IR35. So when IR35 was changed 2 years ago, possibly nearly, so that it used to be the payee's responsibility to worry about the tax. Now it's the payer. And the payer, if they find that they've been wrongly classifying someone, has to start withholding payroll taxes. Currently, there's an issue with double tax, so the company has to make a PAYE payment, even if their contractor has already paid tax on the income. There was no offset, so there is going to be an offset, which is jolly good. So the government can have its tax once rather than twice. Moving on, 9 minutes left to cover the last 3 topics. The first one I want to talk about is the merger of the R&D schemes. So we have currently 2 R&D schemes, a small and medium-sized entity scheme and RDEC, the Research and Development Expenditure Credit. Those are going to be merged into one, which is going to be modelled on the RDEC. It's an above-the-line credit. So the way it works, slightly randomly, is that you receive some R&D relief. That is income for your company, so you're taxed on it. but then there's a sort of net of tax amount which you can get back. The reason for that is to do with minimum levels of corporation tax around the world. There are some changes which are on the slide. The rate is 20%. That is taxable, so it's taxed at 25%. So you end up receiving 15 quid for every 100 quid of R&D cost. If you are a loss-making company, it's a bit better. You get £16.20 rather than 15 due to some quirk in how the rates work. I asked, and there's also improvement on the intent. There was also a new intensive R&D scheme which was launched, where you spend 40%. That was announced in April, where you spend 40% of your costs on R&D, and that's going to be made easier to get. And that's going to be moved to 30%. The reason for this is that the government are concerned that there's a 16.7% non-compliance rate. So for every £100 of R&D relief claimed, £16.70 of that relief is wrongly claimed in the government's view. So that's 1.13 billion of lost revenue a year. So the government felt they had to make a change. I asked our head of R&D, a lady called Justine Stalker, who's the sort of guru on all this sort of stuff, what does this mean? And she said very broadly that companies under the scheme will be able to get more money back because they'll now be able to get some subcontracted R&D. Currently, you can't get R&D on your subcontractor costs, so that's a benefit. The merge scheme isn't as good for small and medium-sized entities as the current scheme. So if you're a small entity, you are losing out a little bit compared to the benefit you got previously. The critical thing and the issue, the thing that causes all the problems with R&D relief is what does the government mean by qualifying R&D? There's no additional clarification on that. There's no change in the rules on that. So all of the complexity that we currently have on R&D and all of the difficulty we have in having we have good claims for R&D, which takes so long to get through because of the revenue sort of interpreting the rules wrongly, or a lack of clarity as to what the government thinks. So that's still going to go on. And the government says that one set of rules will be simpler, so we'll have one scheme. But of course, the intensive scheme is under the old SME rules, so we've still got two R&D schemes in place. So it's not the big issues are not dealt with here. The notification rules, so you have to notify HMRC in advance in order to make a claim, that's still going to stay as well. So there's quite a lot going on, but some of the big issues are sort of danced around a little bit. Moving on to creative sector tax changes. So this is the program of tax reliefs which support film, TV, video games, AV, and cultural sectors like orchestras and theatres. Those moved to a sort of RDEC-like, above the line tax credits sort of model in the spring. That wasn't intended as a restriction on the amount they're going to give away in terms of tax relief, but it was sort of to make it again more tax compliant for international companies, international groups which have a minimum 15% of CT rate. There are some areas, however, that the government's been consulting on. One is connected party costs. So if you have your staff, for example, employed by one company, and they're going to be used in the creation of your cultural work, whether that's a video game or a film or TV program, what price can you charge those staff across at? The government originally said cost, which causes quite a lot of problems on things like, and so for example, if it's intellectual property. So if you are making a franchise movie for a big, I don't know, superhero franchise, what price can you charge your IP in at? Well, what's the cost of that IP? That's quite a hard thing to calculate. And so yesterday it was announced that this would be an arm's length price, which is welcome, but we still don't quite know what arm's length price means, and the legislation hasn't been updated yet. So that's just one to keep an eye on. It's very welcome. We're going to get definition of documentary because obviously things like Planet Earth and stuff like that are hugely expensive, hugely valuable pieces of IP. Many of them created in the UK, and so we want to be sure that we can get tax relief on those works. And there's going to be a consultation on additional support to the visual effects industry. So all cautiously positive on the creative sector front. Now I've got a couple of points to go and 3 minutes to do it in, which is jolly good. Firstly, making tax digital. So there were some changes announced yesterday. As a bit of a recap, this is coming in for self-employed individuals and landlords with income over 50k in 2 and a bit years' time, and those with income over 30k in another year after that. And there had been a consultation as to what would happen to the under 30s, i.e. those self-employed individuals and landlords with income of under 30,000 a year, and whether they would have to be included. And they're going to be not included as yet, but that's going to be kept under review. It's quite frustrating. It's quite a frustrating thing to be part of. There aren't significant changes. There were 1 or 2 slight improvements yesterday. So every business that a taxpayer does will have to do quarterly returns. So if you are a landlord and also a farmer, then you will have to do 2 sets of quarterly income statements. It was announced yesterday those would be slightly cumulative in the way that it works. Previously, if you were in quarter 3 and you found an error from quarter 1, you would have to resubmit your quarter 1 statement and then your quarter 2 statement before you could file your quarter 3 statement. We now think that's not going to happen, and we'll be able to correct errors on the fly during the year. But you still have to file the statements. You would also previously have to do an EOPS, which is just as unpleasant as it sounds, which is an end of period statement. So for each of your trades or businesses, again, your farmer who's also a landlord would do their 8 quarterly returns for the 2 businesses, and then they would have to do an end of period statement for each business, and then they would have to do their tax return. The EOPS are now not going to be needed, which is great. That's a simplification. It's still 9 returns that individual will have to do. But what's slightly scary is the government saying things like, this will be done via the software, this will be done in this way, and the software's just not ready. We have not been able to get, there is a pilot ongoing, but we have not been able to get into it because the sort of clients that they're using it for, we don't have those sort of clients. It is frightening how close it is. When we brought in our new tax return software, which we brought in last year, that was a long project, and all the different bits of software have to talk to each other. So our practice management software has to talk to our tax software, so that we type in data once in the practice management software and it comes across. None of that's happened. None of that's ready yet. The software is nowhere near ready, and then it needs to be released to other software providers who need to make sure that their software connects with it. So we were hoping for a delay. We didn't get one. In other news as well, basis period reform is also a thing. And so if you are not doing basis period reform, for example, if you're an overseas business, it's even worse. So it's extremely difficult for those businesses that don't have a 31st of March year end. And we would strongly urge you to reach out if you're one of those. Very, very briefly, because I've got less than a minute. Missing in action stuff. We didn't get any action on the IHT cut this year. I think it's quite likely to get that in March. Who knows? But 75% of people think that IHT is unfair. Even when the question says IHT applies to people to married couples with assets over £1 million, do you think it's unfair? Still, more than 60% of people think it is unfair on that basis. So, perhaps there's some votes there. If the threshold, if you look at the polling, if the threshold was raised to 2 million, it's about 50-50 as to people who think it's fair or not. But who knows? We were thinking about we might get BPR and APR reform. We are not, but that is very much under the radar for a Labour government. So please do reach out if you're hoping to rely on either of those 2 reliefs. And we didn't get an SDLT holiday, nor did we get reform of multiple dwellings relief or non-residence rates, which we were, the legislation we understand is ready to go. So that is worth thinking about too. And that's great. So that's the end of the webinar this morning. Thank you for joining me. And yes, there'll be a survey shortly. And if you could fill it out, that would be super helpful. Thanks a lot.